Definitely a choppy session for the markets today. We did get a little bit of a pickup right into those closing bells. For more on what we saw in the markets and perhaps where we're going from here, Diana Avigdor is joining us from the TSX, the head of trading at Barometer Capital Management. Diana, good to be able to get your perspective. Thanks for your time.
Thanks, Catherine.
What did you see today? Or my question is always, why do we see a pickup? It's a positive sign to see a pickup into the closing bells. What do you attribute that to?
Okay, so I just want to set the stage for the positioning that we've had until now, and we talked about this. So positioning is not extreme. Shorts are not extreme out there either, but positioning is not extreme into the rally that started in the end of December. So into this light positioning, we've had a seriously risk-off day today, which in the morning felt worse than the Monday when Canada was closed and U.S. was open and down 1.5%, 1.75%. So what happened today? Why did it feel so bad? I think that we took our cues from overnight trading, which was very, very sloppy, and we woke up to futures down a lot on these trade talks. But there was nothing incrementally new in any of the trade talks this morning. So, you know, I'm saying this with a smile, but I am saying it seriously. The markets right now are very technical in nature. There's a lot of headline readers there. The media overnight was very bearish and incrementally bearish, regurgitating the same type of headlines. And the word trade war has featured very, very often. So when you see that and you're an electronic trader or an artificial headline reader, you're going to trigger some programs, and we've had sell programs all morning. But positioning is not there. Also in Canada, with energy down so much, some small cap energy names are pure beta. And if you're going outside the market capitalization of CNQ, Suncor, which were down a lot as well, 4%, I think. I didn't see the close, but something like that. But if you go to the smaller caps, they're pure beta. Beta meaning people buy them purely for the tail, just like you would buy a triple ETF. Well, if you're bullish or bearish on an energy stock, it's those smaller cap energy stocks. So some of them were down 10 and 12% today. It's very, very high risk type of trades, and it's firmly in the hands of short-term traders.
Okay, so a lot there. Just in terms of the positioning that you mentioned, Diana, it sounds as though, what I'm hearing from you, it sounds as though the market moved higher, that there really wasn't a lot of participation in it over the past number of weeks, even the first quarter of the year. So when you get all the selling we got this morning, it kind of just dries up. Is that a fair way to say it?
It dries up, but I'll tell you one more thing. What we've seen in the morning till about 2 o'clock, reports from cash desks. So the trading world now separates itself into two desks, cash desk and program electronic desk. The cash desks are those vanilla, serious, long-term block traders, and electronic trading is, you know, the algorithmic direct market access type of trading. And the program desks these days tend to be a lot busier because of the large growth in the ETF world and electronic trading and so forth. But today, for example, from some trading desks in the US, I got reports that their cash desk was very busy, with more than 50% of their flow better to buy. And this was at the lows of the market. So when that continues, that's the real vanilla buying. When that continues to hold up, electronic traders tend to do what they have to do, and then they pull away, and then you just don't have any more supply. Market making is not what it used to be. It's very fleeting. So the tails in these moves, on the daily moves, can be pretty big.
That's a really important distinction, and I think one of the most important things you said was that the cash desks were better to buy. That's a lot of trading lingo, but it basically means that the long-only money managers or the hedge funds as well, but real people buying individual stocks were buying.
So absolutely. So that's the indication. Now, that's not to say that real people don't use electronic trading in order to spread out their data. They do, but when we're talking about the weaker hands or the short-term traders, and it's okay if you're a short-term trader and that's what you do, and you can pick up a little daily coupon, that's fine, that's what you do. People make money in different ways. But you know that the short-term electronic trading tends to be a lot more volatile. It pushes the prices around a lot more, and so you see this kind of intraday volatility.
Yeah, and I guess another way to kind of add to that is that when you see large money managers buy, or the trading desk is seeing that it's a better to buy situation, they've got a higher conviction in the fundamental story.
Absolutely, that's right. And and if you're looking at fundamentals, so earnings growth was not huge this quarter, but it was okay. We've had a string of weak retailers report the last couple of days, and looking at the macro, the economic situation, the data that's coming out, it's not pointing to anything sinister, especially not in the U.S. And when we talk to our sources or read the macro, there is motivation to have a trade deal done. And if you look at the economic data coming out of the U.S. is well positioned. It's been beating its economic expectations. And China, if you look at their economic surprises, it's been fairly weak. So everybody's motivated to not let this fall apart, although not at any cost. But we've also had in the earnings reports, like for example, Cisco, when they reported, and they're a pretty big company, they did say that all this trade talk and tariffs have made them look at their other sources of supply chain, and they haven't seen a problem in their business. And that day and the day after, market liked it very much, because that is the crux of all this. Can businesses readjust? So we'll see. We don't know what will be, but it doesn't look sinister so far. Market has rallied a lot. If we were to take all the short-term headline risk out and just look at technicals, it's okay for the stock markets to come in a little bit and correct.
Yeah, but that's the technicals. And Diana, it's interesting. I had David Rosenberg on earlier, and he's looking for the Fed to cut rates. He's saying that expectations are too high in terms of the earnings outlook in the third quarter. He's expecting flat. So yeah. There are some indications, particularly on the economic front. I mean, weak housing data again and again. I keep highlighting this to people, and nobody seems to be too concerned. David is concerned, but that's got to be telling us something.
Okay, but the housing data, if you notice, the previous month was revised by about the exact same amount as it missed this month.
Yeah.
So the revision and the miss, bounces out a little bit. Look, 2.5% earnings growth this quarter. It's not huge, but in terms of and this is another issue. Yesterday we had the FOMC minutes, and it did not feel like they were so quick to say, "Oh yes, we're going to cut, no problem," and that kind of bothered the market as well.
Okay.
So that's another reason we kind of opened up at the lows. Just if there is problems and the FOMC is not dovish enough, we're always scared of that December Powell speech that he did and said, right? We're always scared that he's going to turn back, but there is some buying power out there, and like I said, exposures are not high, so they're going from low to a little bit lower.
Diana, bottom line for our viewers, if they're seeing what happened in the market today and they're a little bit nervous, you say what to them?
So short term or long term? Because short term, this is a time to wait out a little bit. You have another 30, 40 points on the S&P, maybe another few days, and I think that it's probably a technical support is a buyable level. For longer term situations, I go back to your diversifier. I go back to an active asset manager that's able to hedge the tail of your portfolio away. So we have some hedges in our portfolios. They're not full hedges. It doesn't take our exposure to zero, but what it does, it takes the volatility somewhat out of the portfolio. The key to portfolios is to always be diversified the right way, have the right possible yield for yourself, and to be right sized, so that you can live out the volatility.
Okay, Diana, great advice there. Thanks so much for your time.
Thanks for having me.
Thank you. That's Diana Avigdor. She's the head of trading at Barometer Capital Management.